As we've been talking about for a while, the market's set up here for a decent correction. So the bears are going to have a bit of a victory lap potentially over the next month or so.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here back at the end of the week for another weekly market recap featuring my good friend, the verdant Lance Roberts. Lance, how you doing?
Doing fine. How are you today?
I'm doing good. First off, Lance, Rabbit, it is the first of the month, August 1st, as we're recording this. Don't know if you guys have that tradition in Texas, but I grew up in New England, and you were supposed to say the first words out of your mouth on the first day of every month are supposed to be rabbit, so you have good luck all month.
Rabbit. It's too late though. I've been talking all morning. So
Oh, really? And maybe in Houston, you guys say something like armadillo.
it could be possum. I don't know.
Well, look, I picked verdant as your adjective for the week because we're going to keep this one short, folks, because literally I have to go to the airport right after this. I'm flying off to Ireland. I think I've let folks know that in the past. My daughter has been finishing up a study abroad trip this summer, so I'm going to meet her there for a little dad-daughter time in Ireland. I can't wait. First off, hopefully you won't really notice I'm gone because we'll be releasing videos on the normal schedule. I've pre-recorded a few. We've got a really good lineup coming. We've got Michael Howell tomorrow, the day after this video airs. Then we have Jeff Clark talking about the opportunity in mining stocks, which he sees as being very high still. Then I've got Joel Salatin, a little bit different fare, but those of you who saw my previous video with Joel understand he's one of the best people in the world, but doing one of the best things for the world in terms of helping our food systems shift to sustainable farming, an investment that's very important for society. And then the last, right before we get back, we'll have the video with Greg Lukianoff, one of the co-authors of The Coddling the American Mind. You probably heard me mention that once or twice leading up to this week. I'm very proud of that discussion. I think you're going to find it really important, but also just really one of the better interviews I've done on this channel. So all that's ahead this week. Let's see, real quick. I wanted to thank everybody who helped me plan this trip. I had a bunch of people from Ireland sending me suggestions, many of which I've taken. I don't have a lot of time there with my daughter. Just FYI, if you're in the area, I'm going to be on the Aran Islands for our first day there. Then we're going to do the Ring of Kerry. Then I'm going to head up to the Northwest for a little bit. But on Wednesday, I might have time to do a little meetup in the Galway area. If you're in Ireland, you might be interested in that. Let me know in the comment section below, and I'll try to get the word out. It looks like at the very end of the trip, Lance, I'm going to hop over to the UK and go visit Sven Henrik. And so hopefully there's going to be some clips on my X account of me actually chopping wood there with Sven next to his famous wood pile. So anyways, if you don't already follow me on X, folks, go to @MenloBear and you can hopefully follow along in the journey. All right, Lance, well, look, busy week. A lot has happened this week. Yep. And I got one question for you. Is it time for the bears to just put on their horns? Is it time to just love the bull market and just get comfortable with it?
Well, that would be a great thing to say like 2 months ago, but as we've been talking about for a while, the market's set up here for a decent correction. So the bears are going to have a bit of a victory lap potentially over the next month or so. Markets are down nicely this morning. We're down about 1.75%. It's ironically, I just posted a chart this morning on X talking about the stretch of days that we've had, so trading days in the market we've had so far, which without a plus or minus 1% move. And that was getting to be a pretty long stretch. These are called buying stampedes. It's where markets just kind of go up every single day, and it's called a buying stampede. Normally, buying stampedes last about 15 trading days on average. So we're at 25, 26 trading days. So that's a very long, push. And so this morning, one thing we've talked about a lot recently is that low volatility begets higher volatility. And, we're on the first day of the new month. We just had a slate of economic data that's showing the economy is slowing down rather rapidly. And, which is surprising considering Jerome Powell's statement this week. He had to have the employment data going into that and, should have been cutting rates, but didn't. So here we are, we've got this, kind of good evidence that inflation is declining, economic growth is declining. That's going to have some implications to corporate earnings going forward. And so markets are kind of waking up to that this morning. But again, the markets were very overbought, very extended. We've had the longest stretch above the 20-day moving average since 1968. So, we're correcting that now as we speak. We actually cracked the 20-day moving average today. So, again, it was time to have a correction. We've talked about this over the last several weeks, take profits. And it's kind of got to be a bit of ad nauseum, like on our radio show every day. We're talking about, hey, take profits, reduce risk, rebalance your portfolio. We're going to have a correction. It's like the market just kept going up. And, it just takes time sometimes for these pullbacks to happen. And so we're having a bit of a pullback now. And it could very well last here for, another week or so to work off some of these previous kind of overbought conditions.
Okay, well, so a couple of things. First off, we're recording this earlier because I got to head off to the airport. So, I mean, today's 1% drop or whatever could very well reverse by the time this video comes out. So we should just put that caveat out there, right? And I do want to talk to you in just a second about the data that, in your words, shows the economy is slowing rather rapidly. Now, on the other side of that, we've had big beats by the Mag 7 stocks, right? A headline GDP, and we can talk about the GDP report, right? But headline GDP was a beat. And again, we can dig into that, but it was a beat. We had the ADP jobs numbers earlier in the week, which were a beat versus expectations. We've had more trade deals get announced. Now, we've also had the August tariffs kick in for everybody else who didn't strike a trade deal, but we've had some pretty big trade deals struck recently. Sure. So this is sort of why I started with, should the bears just put on their horns? Because we've had this relentless buying stampede in the market for so long, and a lot of positive headlines that obviously the administration at least is crowing pretty hard about here. So what's on the flip side of that?
Well, the GDP number is a great example of that. The first quarter GDP number, we saw a negative 0.5% print, and everybody was like, oh my gosh, it's so recessionary, but it really wasn't. The actual GDP report wasn't nearly that bad, because once you dug down into the numbers, you find out that it was all import related, right? We had this massive surge in imports that created a massive push within the GDP calculation, and consumer spending was, it wasn't super strong, but it wasn't bad.
Right. And sorry, just to be clear, just so folks understand, the surge in imports was everybody building inventory in anticipation of the tariffs, trying to front run the tariffs. So it over impaired the GDP print. It made it look a lot more negative than really what the economy was doing. Yeah.
Correct. And the same exact thing happened in quarter two is that now, since I stocked up on all the inventory prior to tariffs, I didn't need to buy any more inventory. So imports plunged by over 30%. That created this massive boost to GDP. But importantly, when you look at the numbers, personal consumption expenditures were made up about 0.98% of the GDP calc. Now, remember that GDP 70% consumption, give or take. That was a fairly weak print for the consumer. So we're definitely seeing the consumer slow down. We saw that same type of slowdown in Amazon's report this week as well. So, we're starting to see more and more evidence of the economy is actually slowing. And once you dig down into that second quarter GDP report, it really wasn't all that good. And it certainly, bids to the fact that the economy and the main driver of the economy, the consumer, is slowing down. And then you take a look at today's employment report, as well as the revisions to the employment report. There was nothing good about that employment report anywhere. So, we're starting to see this, kind of, that data has been grinding slower for a while. We were doing 220,000 jobs a month, and we went to 175. And then, last month was 14,000 and 73,000. This report will get revised down next month as well. So, the evidence that the economy is slowing down is pretty evident. We see that in the construction manufacturing reports. We see that in the services reports. ISM manufacturing index came in today at 48. It was supposed to be 49.50, which is those are both in contraction anyway.
Right. So again, more contractionary than expected.
Exactly. So, it's just that impact. And so that continues to suggest that economic growth is slowing, that lowers the rate of inflation over time, because it's slower economic growth, and inflation is just a function of supply and demand in the economy. So if that's slowing down, you're going to have slower inflation, which is why the Fed, and we wrote this article a couple of weeks ago talking about the Fed's probably going to be, that President Trump's going to be right, the Fed's going to be too late. the Fed probably should have cut rates yesterday, given the light of this data that's coming in, which they had to have going into that meeting. They knew what this report was going to be.
Right. So I'm going to ask you to just put your Jerome Powell hat on and try to crawl in his brain. Is it stubbornness still? I just don't want to. I just don't want to make it look like I'm kowtowing to Trump's bullying. Or is it more, hey, we've got all these new tariffs getting slapped on in October, sorry, at the start here in August, and I just don't know what the impact of those are going to be. And I just would rather err to the side of caution versus cut too early, which he's increasingly about the only person who's thinking it's too early at this point. But
well, the data certainly doesn't suggest it's too early. And the one thing that everybody forgets about tariffs, see, everybody assumes that tariffs are a constant inflationary impact. And that's not the case. Tariffs are a one-time inflation issue. So, just an example, this bottle of water. So if I slap a tariff on this bottle of water and the price of the water goes from $1 to $1.25, that's inflation, right? So it's a one-time inflationary impact. I'm now paying $1.25 for this bottle of water. Next year, the tariff hasn't changed. So the price of the bottle of water next year will still be $1.25, which means I have what? Zero inflation.
Zero inflation. Yeah, we've talked about this. This is why I've been saying it's a price shock. It's not
right. Right. But this is a critical point. And this is the point that I think Jerome Powell, he's so trapped up. My belief is that he's so afraid of getting caught in that, kind of transitory impact of inflation that he said back in, 2021, 2022, which is, he was right. Inflation was transitory. It just didn't evaporate as soon as they expected. And he's so afraid of getting trapped into that cycle again. I think that's he's like, oh my gosh, we might have this inflation boogeyman crop up. And it was the same trap that Alan Greenspan got in back in 1999, kept expecting this inflation to show up from the internet bubble, and it never did, and then led to the dot-com crisis. So, so I think the Fed's just getting themselves wrapped up into a concern that, really they shouldn't be focusing as hard on as paying attention to the economic data, which the trend of the data is clearly slowing and clearly suggests that the economy is getting weaker. And that's not just 1 month's of data. That's the data from the last few quarters has showed this weakening trend within the economy.
Yeah. Now that being said, there's nothing, and correct me if you think this is wrong, but there's nothing that is suggesting the economy is like breaking down and that like recession's imminent, or we're near some sort of precipice of falling into negative economic growth anytime soon. It's just a slowing economy, correct?
Right. Yeah. There's nothing on the horizon right now that says, oh my gosh, we're about to have this massive recession.
Right. Jobs are still growing.
Yeah. The economy's growing. It's just growing at a much slower rate. And it's like we talked about previously. If you take a look at a graph of GDP, you can clearly see where we shut down the economy in 2020 and then sent everybody money, right? And so you had this massive surge in monetary supply and no activity. So all of a sudden, I've got a big supply-demand imbalance because the people that want to buy stuff, they've got money. We sent them checks, right? We did the unforgivable. We sent checks to households and said, "Here's money to spend," and they go, "I can't spend money." So whatever I can buy.
They empty the shelves, but the shelves couldn't be restocked because the supply chains were shut down.
Correct. Yeah. And so for whatever things they wanted, they were all of a sudden willing to pay, $10 for a bottle of water versus $1, right? Just to be able to get it. So that's where that inflation spike came from. But you can clearly see this. So we had almost on a nominal basis, we were growing at roughly 14% nominal GDP in the second and third quarter of 2020. So coming out of that, we sent all these people and the economy exploded. And so it takes a long time to get to negative growth rates. And this is why everybody's been wrong over the last several years. Like, oh, we're going to have a recession. You've got to go from 14% growth to negative growth to get to a recession. That's a huge trip down the mountainside, right? And so we've been slowly declining on that economic growth rate, and we're back down to around 2% growth. We'll probably be sub 2% growth this year. The risk of a recession is now becoming much higher because now we're in the bandwidth we only have to clip 1.5% off the economy to get to negative growth. So we've now got the highest potential that we've had in the last 5 years of actually having a recession over the next couple of years. We've now got that ability because we're so close to that kind of zero rate of economic growth in the economy.
Yeah, and let me just go back to something you've said a lot over previous quarters, which is the economy has decelerated a lot over the past several years, but it's because we started at such a massive height, that sugar rush that you just described, right? That even though it's decelerated an awful lot, we had a lot of distance that we had to cover on the way down. We were still, in positive altitude. Now we're getting kind of close to the ground, to your point. So, any material further deceleration of the economy gets us closer to the zero bound in terms of growth, right?
But yeah, no, that's right. And we're now getting back towards that kind of zero bound of growth, where now if you have an economic shock of some sort, you have some type of event that comes along that all of a sudden really constrains consumer spending. And again, most important, when you're looking at the economic data, remember that 70% of the economy, right? It's like 68%. We're just rounding to 70, makes it easy. But about 70% of the economy is consumer spending. So what you really need is, business investment can go off to the moon. But if 68% of the economy is slowing down, it's going to drag the whole GDP report down. It's just, these smaller components, imports, exports, net exports, 15% business investment, those are such small factors within the overall calculation that it really just pay attention to the consumer, tells you all you need to know. So, again, if we have some type of economic event come along that really shuts down consumer spending, whether it's, some type of corporate disruption, some type of credit related event with some major banks, whatever it is, that could have an immediate impact on the consumer, and we could be in a recession like that. Because again, we're so close to that bound now. 1.5% growth is easy to clip off. Clipping off 5 or 10% is a much different story.
So let me just dig into that for a second. So I agree that we're much more vulnerable maybe now than we were a year or so ago to kind of the black swan type thing that you're talking about, right? The bullet that the person didn't see coming. But let's talk about kind of some white swans out there, right? So one is, the economy is still a bifurcated economy. I mean, the hyperscalers are just crushing it right now, right? But a lot of the rest of the economy isn't growing nearly as well, right? And where are the jobs? The jobs that at least haven't been automated yet, are still in the small to mid-sized companies, right? So as the economy continues to become more sluggish, right, as interest rates continue to stay high, or bond yields, the cost of debt continues to remain high, and corporate credit keeps re-rating, that puts more and more pressure on those companies, right? Yep. And so that's just when we're just over time. Time is not your friend in that scenario if the cost of credit isn't coming down. And those companies presumably will still, will have to start cutting costs and perhaps laying people off. And then that could trigger what you're talking about, right? Similarly, we have the student loan repayment thing that we've talked about, right? Where that is pushing people to have to compromise on other types of debt. And we're seeing delinquencies and subsequently defaults start to rise over a lot of these things. And again, that impairs both consumer spending, cost of credit, et cetera. So we've got some white swans that, given enough time, if we get low enough in altitude, could tip things below the zero bound.
Yeah, no, absolutely. And this is this is where we need to be real careful, right? Because we're not saying that, hey, we're on the cusp of a recession, you better sell everything and get out of the market.
Right. And that's why I asked you that at the beginning. I don't want to give people that impression.
Yeah. We're not saying that at all. But we do have to realize that that the economies do cycle, and that you're going to have growth phases, and then you're going to have a peak. You're going to have a growth peak in the economy, and then you're going to have a growth slowdown, and then you potentially have a recession, and then you start to cycle over again. It's just the way markets and economies work over time. You just can't go up forever, right? You've got to have these cycle resets over time. And so the risk of, and what I am saying is that the risk of a recession is certainly becoming a lot more probable now than it was in 2021 or 2022 or 2023, when all the economists were saying, oh yeah, we're about to be in a recession, there was really no evidence that we were even close to that. Now we're starting to have the level of growth, the level of employment, those type of things starting to say, hey, the spread between a growth cycle in the economy and a significant slowdown or a recession in the economy, that spread is now very close. It's just basically turn a corner and we're going to have much slower economic growth or a recession potentially. And again, we're talking about, and also too, let's clarify something. When we're talking about a recession, we're not talking about a 2008 financial crisis. We're not talking about a dot-com crisis. We're just talking about a normal garden variety, slower growth environment where the economy grows at negative 0.5%, maybe negative 1% at most. And then the economy turns around after a couple of quarters and starts growing again. That's what we're talking about. And that type of environment, markets, stock markets correct by 20 or 30% potentially, peak to trough, but it's not this absolute bloodbath that everybody's kind of been expecting to occur. It's not going to be that, because we don't have the catalyst sitting out there potentially. We don't have like a subprime credit issue. We don't have, while we've got some hyperscalers that are, kind of dominating the market, you take a look at their earnings, they are printing money at these companies. We're not talking about the massive number of dot-com companies we saw back in 1999 that had no earnings, no value,
Right.
no business plan. They just stuck a dot-com on their name. Vastly different stories today. So again, don't speculate when somebody says, oh, a recession is possible. Don't start loading up your boat expecting the financial crisis, because we just don't have that right now.
Okay. Yep. And folks, if and as we tip near the line of recession, we'll be tracking it here on the channel. So hopefully we'll give you lots of advance warning on what's going on here.
Absolutely. And if something starts to crop up, we start seeing credit spreads blow out, something like that, we'll be the first one, hey, there's something cracking on the financial side, right? Beware, raise a lot of cash. We'll definitely be there with you. Right now, we just don't, there's just none of that evidence in the market.
Okay, so we're getting pretty through the current earnings season at this point. Credit spreads, I haven't looked at them in a while. I'm going to assume they're not really blowing out yet, Lance, or I guess you would have already brought it up.
Yeah, no, the credit spreads are as tight as they can be.
Okay, so credit spreads are still really tight. I know that you've been saying for a long time that forward earnings estimates are really rosy. Now that we've gone through most of this earnings cycle, has what we've heard given validation to those rosy estimates, or is it giving us a sense that, yeah, those things are still pretty pie in the sky?
No, they're still very elevated. Now, what happened was, going back to March, when President Trump started announcing tariffs, and then we had Liberation Day, all of a sudden, analysts slashed estimates. And so this big sharp drop in estimates. And then as soon as that kind of Liberation Day passed and the market rocketed off again, all the analysts had now ratcheted their estimates back up to where they were before and higher. Oppenheimer just came out this week and put a $7,100 price target on the S&P by the end of this year. Wells Fargo's right behind them at 6,900, I think. At 7,100, that's a 20% gain for the year. To put that, but that would be the third 20% gain year in a row. So again, whatever concerns there were about earnings and the market in April and May because of tariffs, and this whole terrible outcome that was going to happen because of tariffs, Wall Street's like, yeah, never mind that. Here we are. So,
and this is in the context of a slowing economy, as you've been saying. So to use your parlance, this seems to be a negative divergence between earnings estimates and what the economy is actually doing.
Right. And again, if you take a look at, if you want to kind of know where earnings estimates should be headed, take a look at personal consumption expenditures. There's a very high correlation between personal consumption expenditures and the annual rate of change in earnings growth. And if you are wondering why that's the case, it's because that's where earnings come from, is from what people are spending in the economy. You can't just manufacture.
That's the 70% of the economy that you're
talking about.
Exactly.
So you take a look at Meta's earnings, right? Where did all their earnings come from? The vast majority of it. They had huge numbers, but where was the majority of the growth and the revenue came from? It was from ad spend. Where did a big chunk of Google's revenues come from? Came from advertising. Well, if there's, how are they making all this money on advertising? It's because people are buying ad space from them to go sell products. So again, that's, the consumption into this is what drives earnings for these companies. And we do have, and it's interesting because you talked about, kind of these, hyperscalers. If you take a look at the heat map in the market yesterday on Thursday, it was very fascinating. So Wednesday night, we had earnings from Microsoft and Meta, blowout numbers. If you took a look at the heat map Thursday, you had these three bright spots, right? It was Microsoft, Meta, and Amazon. Big, bright green spots on the heat map. Everything else was red for the most part. There was a few little pockets of green here and there, but for the most part, it was mostly a sea of red. And, and what that was telling you is that, great, we've got these three companies that are just printing money. The rest of the economy is kind of just hanging in there for the most part. And we've seen that a lot lately. You take a look outside of kind of the technology stocks, staple companies, which are, you're kind of the core of the economy. They're kind of just middling along right now. They're not doing great. They're not doing terrible. Healthcare has been under a lot of pressure because of what's going on with the healthcare sector. Real estate is hanging in there barely, but they're still being pressured by interest rates. So you take a look at a big swath of the economy, it's just kind of middling along right now, which is kind of what the economy is doing. And so again, this is, if you want to know where earnings should be going, and two more things real quick.
Yeah, sure.
Take a look at personal consumption expenditures, but more importantly, if you take a look at the deviation of earnings estimates right now from the long-term trend growth of earnings going back to 1900, you're at the highest deviation level ever on record, period, bar none. We've never been higher in terms of a deviation from that long-term growth trend. There's about an $80 differential between where earnings should be and where they're trading right now.
Wow. Okay. Well, that's a pretty declarative point there.
Hold on a second. If you I was trying to grab a chart of this real quick. This is where we are. So this is the deviation of earnings above and below the long-term growth trend line going back to 1900. So we just hit 42.62%, was higher than the 42.57% in the real estate credit bubble. So again, that's what we're dealing with right now in terms of these estimates. And again, these estimates always fall short. They always get revised down. That's why we have millennial earnings season, on a regular basis. But that's what's going on right now.
Wow. Okay. It's another great example of, historically stretched valuation metrics. So I'm going to add that to the pile, Lance. I mean, we've got a lot these days, right? So a couple of things. First off, a couple months ago, when stocks started rocketing back after Liberation Day, and had surpassed the pre-Liberation Day's highs, I think I recall you guys saying, hey, look, we expect this to continue to be a volatile year. Sure, maybe the S&P can finish up 5% or 7% or something this year. And you had a price target for the end of the year at RAA, and I think you had said we're not raising our price target, but we think we could come in at the higher end of it now.
Yeah.
Are you guys changing your price target at all? Are you moving in higher based on all these other much higher estimates you're seeing out there, like the 7,000s?
No, not right now. There's still the real risk that we could have another 5 or 10% correction sometime this summer, August, September, then rally into year end, kind of get back to where we are now and be up 8, 9, 10% for the year, which has kind of been our target since the beginning of the year. We said, hey, look, it's very reasonable. We could make an 8, 9% return this year, but with a lot more volatility. And we've certainly had a lot more volatility. The market's up about 8% for the year. And, from where we are right now. And so if we give that back and then rally back to where we are, maybe a little bit higher, we're probably not going to be too far off that mark. But again, there's, trying to predict a year in advance is a crapshoot. And what's really more interesting to me right now is that you got record level of retail options trading in terms of volume. You've got this whole meme stock thing. I mean, you've seen what's been going on with, companies like American Eagle Outfitters and, some of these other, $3 stocks that have had just huge runs. We've got this whole meme chase, back again. The most shorted stocks are, performing the best this year because it's a lot of speculation. So the one thing that really concerns me right now is just this real kind of record level of speculation that we see going on. It's we've talked about this before, it's so reminiscent of what we saw in 2021. And the thing is that it doesn't mean that it ends tomorrow. But when it ends, I think there's going to be a lot of retail investors that are going to suffer very major losses in the markets. And right now they feel bulletproof, and you can't blame them, right? It's like whatever they buy, it just goes up. The more risk they take, they're just printing money right now. And so when you hear some old boomer like me sit there and go, "Well, you're going to lose some money if you do that," this was 2021. And the market did that for an entire year, actually a year and a half. The market just surged higher, very low volatility. I think our biggest drawdown we had during that entire advance was 5% at one point. But other than that, it was a very low volatility, just surging advance. And it didn't matter what risk you took, you got paid for it. 2022 though comes along and the market was down 25%, but most retail investors were down 45 to 50 during that because of all the risks they took. And unfortunately, I just think that's going to happen again. So, this is why we keep talking about, look, it's okay to take risks. It's okay to speculate. I'm not being just some old boomer telling you that, it's like, beware, get off my lawn. I'm not saying that. What I am saying is it's great to make money. Just don't forget to you don't make money until you sell something and put it in the bank. And, if you wind up turning all your gains into substantial losses, because you felt bulletproof, then what was the point, right? I mean, the whole point is if you're making a bunch of money, it's fascinating. I wrote that article about that guy in Canada that made like $100 million off trading some stock. He was leveraged up, did margin, was doing call options, and wound up with zero. And it's like, at what point did you have $100 million and go, you know what? I think I'm gonna put 20 million in a CD just in case, just in case I still walk away with 20 million bucks. But that's what happens to most investors. The greed factor takes over. They feel like they're bulletproof, and then something's going to happen. And something's going to happen to this market. Doesn't mean a 50% correction. Again, not saying that, but it's really possible if you're taking a lot of risk, options, speculation, leverage, you're going to lose a lot of money.
Well, a few things. One, we know right now that retail investors are more exposed to stocks than they've ever been as a percentage of their portfolios, and that the oldest cohort has the greatest exposure, which is ridiculous. It should be the other way around, right? The older you are, the more conservative investments that you should be having. But the retirement age demographic now has the highest percent exposure to stocks it's ever had, which just means, Lance, if there's an equity correction, it's going to hurt a lot more than it has previously.
Right.
So, but let me just say this too. We have the benefit of hindsight now, looking at 2021. And we can sort of say, okay, look, one of the reasons why it was so bulletproof for so long was because there was just so much stimulus that had been pushed into the system, right? Just trillions and trillions of monetary and fiscal stimulus, right? We don't have that now.
I know, which is the amazing thing about this whole rally is exactly that. It's baffling to me.
Yeah. So, I mean, I just think if you're feeling cocky, right, you have to have a really good, compelling reason why whatever tailwind you're counting on to continue from here is going to continue when you don't have that incredibly unfair advantage you had back in 2021, and the economy is slowing in the way that you've said, Lance.
Yeah. So, but again, markets can do phenomenal things, right? And they tend to always do exactly the opposite of what we expect. And, this is why, you and I spend so much time talking about narratives and contrarian investing and those type of things, because when everybody thinks the market's going to crash, that's generally when it doesn't. That's when, markets kind of take off and start doing something else. Or if everybody thinks the market can do nothing but just go up, that's when bigger corrections occur. And that's in everything. It's in the dollar, it's in gold, it's in stocks, it's in bonds. All these type of things go through mean reverting events at some time or another. We can assign all these narratives to them. We can say this asset price is going up because of A, B, or C. And we say this asset price is going down because of A, B, or C. But eventually that's going to change, and that asset price is going to start going in the other direction. Why? Well, because people see opportunities like, man, that's really beaten up. I can go put capital over there and I have enough capital to move that market. And all of a sudden I can start making money with it. And especially when things are highly shorted, like take a look at the dollar just over the last, couple of weeks, it's had a huge rally. So again, there's so much shorting on the dollar. It doesn't take a lot to squeeze that dollar higher. And there's traders making money off of that.
Right, right. Well, and it's just you cautioned us, look, valuation's not a great timing metric, right? But you've also said, look, in the middle of the run, the herd is usually right, but it's usually at the extremes when the herd is wrong, right? And in the depths of the post-Liberation Day lows, nobody would have imagined that this year would close positive, let alone potentially up another 20%, right? And they were wrong, right? Now we're kind of on the other end of that level of extreme, right? Where now people are talking about it. Yeah, and a three-peat, 20%.
Yeah.
And again, this could very well be where the herd may be proved wrong at the extreme.
Which is why we're not raising our price targets.
Okay.
I mean, that's why. Look, I am still convicted, and look, I could be entirely wrong. But at the beginning of this year, we wrote that whole article called "Curb Your Enthusiasm," which was, basically saying, "Hey, just expect a year of a lot more volatility." And I still and we're still adhered to that premise, which is we still think that there's risk here of a 5% correction or so over the next month or two, and then a rally into year end. And we'll get out of this, and we'll say, man, we'll look at the market, and go, hey, market was up 10% this year, but you took a lot of bruises along the way, right? And that's the real question is did you survive that, or did you make investing mistakes by selling the April lows, buying the July highs, getting trapped up in the sell-off in August, September, and selling out again because now the market's going down because of tariffs or whatever, and then you miss the rally into year end? That's what hurts investors, is all the psychological mistakes we make in managing our portfolio over time. And we went into this year expecting volatility. We've been navigating based on volatility. We've given up some gains this year because we're holding 12-15% cash right now. But that's okay, because we still think there's more volatility to come. And if I get another corrective sell-off over the next month or two, I'll put that 15% of cash to work for the end of the year. But again, we just haven't had the right setup for that just yet.
Yeah, yeah. And just to, talk about how volatility isn't quite dead yet. Today is becoming more volatile as we talk. The S&P is down about 1.5% now. Oil's down, what is that? Over 2%. We're seeing risk on assets like crypto get pretty banged up too. So, again, coming in, literally as I was writing, my notes for you today before the market opened, it was, should bears, put their horns on at this point, because it just looks like the bulls, have totally got this market, wrapped around their finger. Well, all of a sudden the bulls are like, whoa, wait a minute, maybe we don't, right? So volatility is not dead, to your point.
Yeah, exactly. And look, this is also the beginning of a new month. So it's kind of, portfolio managers are setting up for August, September. Everybody in Europe is going on vacation starting today. So if I'm a European money manager and I'm going to go on vacation for a month, I don't want to be worrying about my markets. So, I'm going to lighten up some of my exposure to markets and those type of things. And that's a kind of an annual thing, right? We know that. So you just have lighter trading over the next 2 months. So it just means a little bit more volatility. But again, let's go back to earnings real quick. We've had a very, very good earnings season, 85% beat rate, give or take. The problem with that is that we lowered the bar so much going into earnings season that the beat rate was going to be expected, right?
Okay, so, but that's your whole thing. Everybody's getting their trophies right now.
Yeah. Well, the problem is now that bar is a lot higher. The analysts have been ratcheting up their estimates for the third quarter. So they've now moved that bar up for the next quarter. And while a lot of companies were beating earnings, they were beating earnings by a little bit on a much lowered bar. So if you raise that bar too much, it's going to become much more of a challenge to beat those earnings in the next quarter. So especially if we continue to see economic growth slow down, if we have any type of growth hiccup at all, third and fourth quarter earnings announcements could be a lot tougher.
All right. We're going to have to wrap up
I know.
somewhat soon.
I know.
So no, I know. But just a couple of things I want to squeeze in. One, Lance, can you, while I'm talking here, pull up the chart? I just want to make sure that folks see the TA, because especially it looks like if we're coming back down to that 20-day moving average and maybe in some interesting technical territory, I want folks to see that. Let me just ask you this as you're pulling it up. Back to the Fed discussion this week. It is a little interesting that, Powell should have known what this payroll report was going to be like, but he didn't seem to be sweating it at all. But there were two dissents on the Federal Open Markets Committee, and that's rare. I think it's actually the first time since 1993, I think, that there were two dissents. And notably, the dissents were Fed governors. So the presidents of the Fed banks tend to be, the more sort of cynical ones. They're closer to the data of the real world. The governors are more sort of political appointees, and they tend to just sort of line up behind the Fed chair. But you had two governors who dissented. Now, the skeptic in us could say, well, they're just competing for Jerome Powell's chair, and they're trying to signal to Trump, hey, Trump, I think like you do, pick me, right? And that very well could be going on. Or, Lance, I'm just curious, how much do you think of it as that sort of posturing versus them looking at the same data that you're looking at and saying, whoa, wait a minute, like this economy is really starting to slow. We've got this jobs number the world hasn't heard yet, but it's about to come out. It doesn't look so good. Yeah, maybe we should start cutting.
Yeah, no, I think it's part of the latter, is that the data again suggests that they should be cutting. And again, this was the first time we've had two Fed governors dissent. It's very unusual that happens. Generally, they're much more in line. So again, I kind of think at some point maybe Jerome Powell's got to be sitting back today going, maybe I should have cut. Maybe I should have gone kind of thought about this, or at least been a little bit more cautious in kind of, because if you take a look at this is kind of press conference and the announcements after, it tilted a little bit more dovish. It wasn't as hawkish as it's been, but maybe he should have been a little bit more dovish about, or at least tailored his sentiment, saying, hey, we're not cutting today, but we're really watching this economic data, which is weakening, and it's very probable that we're going to be cutting rates maybe at the next meeting, whatever, or at least alluded to that a little bit more. Maybe the markets would, kind of responded better, but we'll see. But, but no, I think that part of, the two Fed governors is that they're looking at the economic data saying, we want to be ahead of this, not behind it. And that's the real risk. As I said before, the risk the Fed runs is getting caught flat-footed, and they're having to cut by 50 basis points at a whack. And why that's important is that if the Fed just cuts rates 25 basis points, say yesterday, says, hey, we're seeing some weakening in economic data, nothing critical. We're not on a recession binge. We're seeing it slow down. We're going to go ahead and cut 25 basis points because the current Fed target is well above the current inflation rate. So we need to kind of reduce that break on the economy a bit. Markets will be really good with that. What the markets aren't good with is we're cutting 50 basis points today because, we just, hit an air pocket in the economy. Right. That markets do not like that. And that's where you run that risk of a much sharper reversion in the stock market.
All right. I'm going to steal the screen for just a second here.
Yeah.
Because as you were talking, I pulled up the latest FedWatch data here on rate cuts. And I just want to show you. So right now, there's an 80% probability of 81% probability of the Fed cutting in September. Now look at this. So it's 80.8 down here. Just yesterday, it was at 37.7.
Yep.
Right. So massive sentiment shift in just the first few hours of trading here today.
Yeah. Amazing what a bad employment report will do for you.
Yeah. Isn't that? All right. Sorry, I just wanted to put that corroborative evidence up there. All right. So if you want to pull your screen back up here, but we can see here. Yeah, clearly. I mean, today's action at least has punched us notably below the 20-day moving average. And as you said, we've been hovering above that thing for a very long time.
Yeah. And again, so we had a very long stretch. As I talked to you before, I think last week, that blue line at the top, that kind of diagonal blue line, and the line on the bottom we laid out probabilities about 3 weeks ago. We said about a 50% chance this market can continue to rally, 35% chance that the market declines, has a bigger correction back towards 6,000, and about a 15% chance the market just went sideways. So right now we're in the 15% chance the market's just going to be traveling sideways for the next, couple of weeks. I don't think that's going to be the case. I do think we try to work our way down towards that red line, which is the 50-day moving average. That would be very normal and would give you a much better entry point for the market. We've got about half of the relative strength overbought condition now reversed. And you can kind of look at whenever you have peaks in relative strength, the market tends to kind of sputter a little bit. So we're kind of working through that. We got a MACD sell signal at the top. So momentum clearly showing a decline here as well. And then that shaded area in the background, that's money flows clearly declining. And you can see that even though the market was flirting with all-time highs, money flows were declining. And that was telling you also, this is why we pay a lot of attention to money flows, that was telling you that the momentum of the market was weakening and that buyers were becoming less available for sellers. So again, as always the case, what causes this is that people are wanting to sell and the buyers are going, yeah, I'll buy from you, but I'm going to buy at 62.43. I'm not going to buy from you at 6,400. Right. So what right now there's some buyers sitting there, but tomorrow we may find out that what buyers were there at 62.40 are now down at 6,200 or wherever. And we kind of work our way a little bit lower. And I suspect that could be the case over the next week or so.
All right. So if it does go down to kiss the 200-day moving average there, Lance, and barring there's no, massive sign of calamity, right? I assume that you're going to start buying there.
I might buy at the 50, depending on how far we are oversold at that point, and if the market starts to stabilize at the 50-day moving average. But
I'm sorry, I meant the 50. The 50 is the red one there, right?
Well, no, but the 200-day is also very important because markets do regularly test the 200-day moving average as well.
Yeah. I know. I know. I'm sure you would load up there, barring no calamity. But looking at your red line here, your dotted red line, if you were to get down to that, I would think because you were thinking that was the low of your probability set, you'd start buying there in some material amount.
So what would be determinant of that, Adam, would be two things. One, I'd want to see relative strength closer to 30 than 50. So I'd like to see this come down a little bit more. The second thing is I'd like to see this momentum indicator, which is very overbought right now. I'd like to see it work itself back down towards zero from 80. Now, that might entail a bigger correction, like 5 or 6% in the market to do that, which would get us closer, by the way. From peak to trough, it's about a 6% decline to the 200-day moving average. So, it's not that far. It looks big, but it's not that big, which would be, 5% correction, completely normal any given year. So again, somewhere in this range, we'll work off some of this overbought condition and have a lot better entry point. And I've got a shopping list of stocks that I'd like to add to in our current portfolio and a couple I'd like to buy. But again, we need to see better entry points to do that.
Yeah. And I imagine another thing you'd want to see there too is capital inflows growing again. And we've seen, and I'm talking about this sort of yellowish chart in the middle here. We've seen that really fall off as expected, I imagine, during the buyback blackout window, right? So I'm presuming that, we're getting near the tail end of earnings seasons. Once we're through that and companies can start buying back again, I'm assuming that would be another sort of all clear signal you'd be looking for, that capital flows are starting to go up again.
Yeah, absolutely. So, so what you're looking for and with money flows is you're looking for it to bottom and turn back up. So again, I mean, what that means is you're not going to catch, I'm not going to catch the absolute bottom. Like, this was the April 6th, 7th lows right here. And then the market surged higher. But, when on that market surge, you can see that money flows turned sharply positive. So that was kind of your buy signal at that point to get in. So what you're looking for is these reversal of money flows from, going down to going back up to suggest that buyers are coming back into the market with more volume, those type of things. And that kind of helps you let you know is like, as if money flows are trending higher as they were like this whole period, that just means, stay invested because you've got the kind of the wind at your back. But when you start to see this deterioration, that's when you want to lighten up a bit. Like a couple of weeks ago, we saw this. We took profits in Palantir and GE Vernova and some other stocks like that. And we kind of rebased some of that money into some more defensive areas of the market. which are holding up better today. We bought Costco, which is green today, while the rest of the market's down. That's what you're looking for. Is you're looking for that ability of money to rotate within the market, go from risk on to risk off, catch that rotation in the markets, and then once those money flows bottom and start to come back into the market, then you can rotate more back to your risk on type stocks. So that's where we'll add back to the more higher beta, higher growth type companies.
Okay. I want to get to your trades in just a second here, Lance, but I do want to talk for just a moment about bonds. So on the day we're talking here, the 10-year yield has dropped by 2.5% or so. Meaning, as investors become more concerned about a slowing economy, and obviously a disappointing or discouraging jobs report, treasuries seem to be, still exhibiting their safe haven role, and that I think has been part of the optionality part of your bond trade there at RIA, right? Which is, hey, you think the trend is going to be downwards in these bond yields in general, but if there are hiccups along the way, that capital still is going to seek shelter in the long bond. True?
Well, yeah, but also remember that again, just caveat is that we have to own bonds because we run allocated portfolios, right? So, but like in our 60/40 allocation model, only 5% of our portfolio is long duration bonds. The other balance of that is either cash or treasuries running between 1 and 5 years. So we're on the much shorter end of the duration risk curve of that, because when the Fed starts cutting rates, that's the first place it goes. So we'll see the biggest capital appreciation from a Fed rate cut in September on that end of the balance sheet. And then once we start to see economic growth slow more and start to see the capital flight from into bonds out of other assets, then we'll shift that duration to long end and pick up and add to our longer duration bond exposure to pick up on the reversion of economic growth and inflation, which then benefits the price of bonds on that end. So there's a bit of management to it. It's not just a stagnant kind of buy and hold strategy, but that's where the premise is. And importantly, if you take a look at treasury bonds, is like the TLT, it's forming a very interesting inverse head and shoulders pattern right now. It's been basing here for quite a while. We've been traveling between 4.1 and 4.45%. And if you take a look at treasury bonds, they're forming an inverse head and shoulders, and the US dollar is now forming an inverse head and shoulders and starting to break out of that. So if we start seeing more foreign reserve capital going into the US, which we just had the largest capital flight of dollars into the US since the April lows. We just set a record, like $1.7 trillion of foreign inflows into US capital. If we see a lot of that, if we start seeing reserve currency shift back into that area as well, then you've got a lot of potential upside in the long bond as well as the dollar.
Okay. All right. Well, folks, we'll be tracking that closely then, if those trends continue from here. All right, Lance, got to start wrapping it up here. Trades. What trades, if any, have you made over the past week?
None this past week. We're, like I said, we went into this, at almost 15% cash. We've already done rebalancing in the portfolio, so we didn't really need to do much right now. And the stocks that we own are holding up really well. I mean, right now I'm looking at the market. The S&P right now is down 1.61% for the day, and our portfolio is down at this moment 25 bips. So, if the portfolio is down 25 bips in a a 60/40 allocation right now is down 73 bips. So, I can handle a 25 bip down day in a market that's down 1.6. So, again, I think we're well positioned for this type of volatility. And we were actually outperforming the S&P earlier this week, because of our weightings in stocks like Microsoft and Google and others that perform very well.
And folks, this is why the science of investing is so important. And Lance and I spend so much time on these videos talking about things like risk management and diversification and position sizing and rebalancing and all that stuff. And I know, Lance, when the markets are stampeding the way they've been over the past bunch of weeks, you get some people that are like, dude, why are you not fully allocated in your model? Why are you holding on to this cash balance, right? And, it can be, this way, I'm sure it's not very fun for you to have to explain to people why you're doing this, but of course it makes all the sense in the world when you have a market turn. Today is just, Is it the start of something? Is it just a blip? We don't know yet. But to your point, when you show those relative performance differentials, that's where you really appreciate following the science.
Well, and true. And see, that's the hard part for people to kind of understand. So our 60/40 allocation model is now this is through yesterday. It hasn't captured today's. This is returns as of yesterday. So on if you go to simplevisor.com, which is our kind of do-it-yourself research platform, then you'll find some portfolio models that are there. And we're about to add a whole bunch more starting next week. We're going to have 8 thematic models as well as an additional kind of managed model as well. But I funded each one of those. So when you're looking at that performance, you're actually looking at the performance of a Fidelity account that I'm actually trading. So it's not just some random model, et cetera. It's an actual account. And we track all the trades. So you can look at the transactions, everything we bought and sold historically. This model goes back to 2019 when we started. We started it in January of 2019. But you know, it's interesting because you're right. When we're having this raging bull market, it's like, why are you holding 12, 15% cash in your portfolio? And I'm like, well, because it doesn't matter. Right now, I'm trying to hedge some risk. The 60/40 equity model is up 6.76% for the year. As of yesterday, the S&P was up 611. So we're traveling along with the index right now, but still holding less. We're holding more cash. We've got lower volatility, more cash, and we're still tracking along with the market as it is. So
right. To be matching the market with less risk.
Yeah,
that's everybody's goal, right?
And
you sleep better at night.
Yeah, and I actually misstated because I said that was yesterday's numbers. It's as of today, so I just got the live update. So
okay,
as of today, the equity model's up 6.76, and the S&P is up 611 with this decline today. So again, it's okay. I'm not trying to. The S&P is not my benchmark. My benchmark is another 60/40 index. That's my actual benchmark for that model. But the point is that I can run a risk-reduced model and still perform well with respect to the market without taking as much risk. I don't have to have all the risk and potentially take all the risk of a drawdown, which is the thing you're trying to avoid.
Okay. Well, look, let's start to wrap it up here, folks. But exactly on this point, if you would like to get some help in having your money managed in a way that leverages that science we're talking about here, and brings in, all the tried and true best practices of portfolio management, and can help you keep your head, especially at moments where the market may be turning like it might be doing right now, but certainly if volatility continues to return to this market. If you'd like to benefit from that type of discipline, and I highly recommend that you seek the guidance of a good professional financial advisor, one that takes into account all the issues that Lance and I have been talking about here today. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you just like a second opinion from one who meets those criteria, perhaps even Lance himself and his team there at RIA, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the very short form at thoughtfulmoney.com. And the firms will be in touch with you immediately after you fill that out. All right, Lance, I'm officially putting on my vacation hat right now.
Good.
And folks, if you want to follow along, like I said, go follow me on X. The handle there is @MenloBear. Also make sure you show Lance a lot of love while I'm gone. Go watch his videos on his channel every day. But also show him love by hitting the like button and then clicking on the subscribe button below. Lance, my friend, I'll talk with you off air here. There's a chance I might be able to sort of find a little window and we can record another short market recap next week. Or maybe if you're free and you and Michael just want to sit down and record something on your own, we could do that too. We'll talk about it off air. But I'm going to try not to bug you much next week. But who knows? Maybe we'll do a little thing from the road.
Yeah, no problem. And starting next week, so I was on radio for 25 years as of this month. And so today was our last day of actually doing live radio. We've done a live radio broadcast for 25 years. Today was our last official live broadcast. So starting Monday, if you've been listening to us on the radio all these years, thank you so much. It was a great honor, great privilege. We're just moving to all digital. So you can find us on YouTube. We stream live on X. We stream live on Meta. So again, go to our YouTube channel, The Real Investment Show. You can find our show there. And again, so absolutely, if push comes to shove, next week, I can just schedule a quick call with you or something, and we can do a short video for your audience, or we'll figure out something. Absolutely.
All right, great. Hey, look, 25 years. That is a massive accomplishment. Congratulations.
No, thank you. It's just definitely makes me feel old.
All right. Well, folks, definitely give Lance some love in the comment section below. Lance, buddy, another great week. Thanks so much. I'll see you on the flip side.
You got it.
All right. And everybody else, thanks so much for watching.